Rip higher into the 2020 elections, but we're still in 2019.
Yes.
A lot of uncertainty about the trade war. Federal Reserve has paused and said, we think we've done enough. If we have to do more, we will, but we think we've done enough. Then we get some not so good retail indications. So how do you feel that this sets the markets up for a year when they are going to rip higher ultimately? Do you think the Fed's going to cut rates more? What do you think?
No, that's a great question. That really hit the nail on the head. And why that's important is all those things you just mentioned are economic factors. And what we've seen in the last, particularly 8 years, is the relationship between underlying economic factors and markets is sort of disconnected. Why we believe we're seeing markets move up to November 2020 with the presidential elections is simply the Trumponomics momentum trade, which began in November of 2016, and there's no signs that it's going to end between now and hopefully by November 2020.
So what else has to happen besides that, though? I mean, does the economy have to keep on track? Does the trade deal have to, the first phase at least, get signed? Because certainly, if the trade war really continues, if there's no deal at all, tariffs stay on and get higher, you've seen what's happening to China, the slowdown there. This has not been good for U.S. manufacturers. It hasn't been good for a lot of manufacturers around the world.
Been very bad for Australia too, of course. Look, the issue with that premise is that Trump will stop the trade war. It's the best thing he's ever done from a political point of view, simply because it's his primary policy or stance. There's no way that he's going to not pull that card, particularly if he's not doing well leading up to November of 2020. Whether that's a good or bad thing is obviously an important side conversation. But from a market's point of view, if you expect the momentum to keep moving forward, there's only one way we get from here to there, which is we've seen here in America. You can call it what you want, but in effect, QE4. In Australia, we're talking about printing money as well, whether you call that QE or UBI, MMT. It comes by many names, but we're already going down the same path, and there's only one way to inflate your economy from, and the related financial markets, from where we are today to that point a year from now.
Stirling, your views do contrast somewhat with a guest we had on in the previous hour, George Ball, CEO of Sanders Morris Harris. He believes that we're getting near the end of this bull run, that after 10 years we're due a correction. He's seeing fissures in the US consumers, and no resolution to the trade war can only make that worse. So how would you counter that argument?
Sure. Well, again, the premise behind those points is that there's a relation between underlying economics and markets. The issue that we're seeing at the moment is this hyperconvergence between fixed income. We saw it obviously earlier this year. Everybody was potentially saying that there's going to be a recession, which is an economic phenomenon happening after the inverted yield curve in the US. That didn't actually happen, and we've rallied for about 8 to 9% on the US markets since then. In Australia, we've had 11 inverted yield curves in the last 9 years alone, and that hasn't really been covered too much as well. So again, using economic principles that worked pre-GFC to what we're currently seeing in the era where, again, call it what you want, unconventional monetary policy, or the mechanics that's stimulating underlying markets at the moment. You know, if you understand what should be happening, the premise of your last guest point was that there is still a business cycle. Business cycle was a theory was invented in 1967. Whether we still have business cycles and the relationship between that and financial markets is yet to be seen. But not to say that you should obviously ignore those economic factors, but you should not make assumptions that made sense pre-2009.
To your point on yields, we have seen yields climbing towards the end of 2019. Is that a trend that you expect to see continue?
Yes, we do, but just to be very careful in the Australian scenario, what the Americans did with QE1, and you could argue we're just seeing QE4 here in America, what the ECB and the Bank of Japan are currently doing, will be very different to what our Reserve Bank of Australia could or should be doing. Our yield curve and our relationship with fixed income markets is fundamentally different than any other market in the world, particularly with our dependence on the property market, as we all know back in Australia. But again, it should not be forgotten that Australia is the only advanced economy in human history to avoid a cyclical recession for 28 years. There's nothing natural about that at all. Why that's the case is, again, a longer conversation. To make the assumptions that what applied here in North America to Australian scenario is a dangerous path to go down in and of itself.
So Let's say I buy your premise, and I think for a lot of people, even if they're not going to vote for President Trump, they probably like the idea if he does win, that's going to have you create this rip-roaring rally. How do I make money? Where are you putting yours?
Again, I would like to put a preface on this. None of this is good. This is not a healthy scenario that we want to be manipulating markets and decoupling the underlying economy from financial markets. But what happens in reality and what we want in life aren't always the same thing. To answer your question, at the moment, if you do believe there's a disconnect between the two, none of us can guess when that business cycle and the financial market behaviour will disconnect, particularly, as you mentioned, if Trump does get a second term. And it is important to note that he is talking about amending the 22nd Amendment and potentially going for a third term, but that is another conversation. What is important at the moment is to obviously see what's happening from that momentum trade, but also there are some very boring, non-market correlated opportunities. And again, there's a whole lot of geopolitical overtones at the moment, but also thematics. For example, we're seeing the change in silicon. Silicon carbide is a new type of fundamental science that's fundamentally changing microprocessors. That will obviously be affected by the trade war, relationship with Korea, Taiwan, and obviously China as well.